A Federal Reserve pivot will crash markets even further. No. Hey everyone, Meet Kevin here. This particular chart has been trending as of the last couple of days, specifically on Reddit. I'm going to break this chart down, but we're not actually going to spend most of the time breaking down this chart because it's actually overly simplistic and misses some really key elements of what actually could drive our market to rebound rather than crash. Let's talk about the Federal Reserve pivot and why the Federal Reserve pivot in this case might not be what you think it is. So, first thing, okay, this is first impressions. I want you to look at this chart and ask yourself, okay, what is the takeaway of this? No, the takeaway isn't that this video is brought to you by Mojo, although that is true, and we'll talk about them in a little bit. There's a link to them down below. But let's first talk about this chart. So, briefly, this chart tells you a few things. It tells you that when the Fed pivots, stocks crash by more. Okay, is that causation without correlation? Or is it because the Fed pivots, they end up leading stocks to crash? In other words, is it just a coincidence that stocks happen to fall more? Or is it because the Fed pivoted that stocks fell? Well, first of all, what do they mean when they say pivot? Okay, definition. Pivot is the first month of Fed cut rates in economic cycles, and then they're comparing the stock returns to the S&P 500, or they're using the S&P 500 to determine what stocks do. Okay, that's fair. I agree that we could use the S&P 500, and I agree that to some degree a rate hike is a version of a Fed pivot. Okay, fair. So what do we have here? We have the global financial crisis, and we have a Fed pivot in August of 2007, and stocks crash an additional 50%. Dot-com bubble December 2000 pivot, 38.3%. Oh no, minus 4.4%, minus 16. Oh my gosh. Every single pivot is led by a further stock decline, all the way with an average of negative 22% returns, with a pivot to bottom time frame on average of 13 months. Oh no, wait a minute. I thought when the Federal Reserve U-turns, it would be good for the market. Why is this wrong then? Or maybe it's not, maybe it is true. Well, first, let's understand a few things. This chart tells us a pivot, which is the first rate hike, right? Now, what we want to understand or compare this to is what we originally call the Fed U-turn, which is synonymous, should be synonymous, with bailout, okay? So the Fed, like when does the Fed say, that's enough, let's bail out markets, right? So let's call one version the Fed bailout. We'll call this the old U-turn. And the reason I call it the old U-turn is just because it sounds so similar to pivot. And pivot will be the first rate cut. Sorry, not hike. There we go. First rate cut. Okay, perfect. So pivot, we have the chart for. What do we know about the Fed's previous bailout cycle? Well, we know that the Fed's bailout cycle actually didn't start until the S&L crisis, and specifically Black Monday. Black Monday, not like a Black Friday sale for coupons, okay? We're talking about Black Monday. This was October of 1987, and it was a devastating stock market crash where the stock market fell 20% in a single day. The computer era just came of age. It was October 19th, 1987, and that's it. People thought the stock market was going to end. And so the Fed actually said, we will stop at nothing to backstop markets. That was in 1987. And the rest of the Fed U-turn dates, which I'm going to provide you, we're going to call this the first Fed bailout U-turn date. Then there's a second one that happened. There's a third one, a fourth one, and a fifth one. So far, we've had 5 Fed unlimited bailouts. That's actually it, which you'll notice that's less than pivots, and they all happened since 1987. And that is really, really important. But first, we got to get in a message from our sponsor. Now look, Mojo applies to New Jersey. So if you're in New Jersey, you want to listen to this because today's sponsor is Mojo. It's a sports stock market that lets you invest in the career of athletes. There's never been anything like Mojo because it's a new way to invest in an athlete's entire career with a guaranteed stat-based payout that gives the stock intrinsic value. No buyer or seller matching is necessary, and Mojo wants you to know this isn't like trading cards or NFTs. And the stat-based payout is kind of like a dividend, which is really cool because that is guaranteed. In addition, you could go long or short instantly and build a portfolio in minutes. It's the holy grail for sports fans because it's the only grail. The app currently offers over 300 NFL skill players, with each athlete a stock having a share price that rises and falls in real time as the market tries to guess the ultimate value of the stock, in this case player. There are app-based features as well, like performance and news and anything else that might affect expectations or impacts on prices, and prices move all year long, so there's really no off-season. For example, check out Daniel Jones or Zach Wilson. You can buy and sell instantly and hold for as long as you want for a play, hold for a game, hold for a season, hold for an entire career. You can even compare players, and remember that certain players have free multipliers attached, so you can boost your returns by up to 15x. That makes even established stars like Brady or Rodgers as volatile and exciting as the rookies. Mojo is currently offering a free 10x multiplier on New York quarterback Zach Wilson. Join the action now and check out Mojo. Mojo is available in New Jersey on iOS, and download the app to get your first stock free, worth up to $10,000. Once again, click the link in the description for your first stock free, worth up to $10,000. Thanks, Mojo, for that. So welcome back. So the next U-turn that we had was actually in March of 2003. So what's interesting about this is you actually have the Fed bailing out markets in October of 87, in March of 2003, and this is actually in alignment, ironically, with the bottom of the market, in alignment with bottom. And we're going to see how this is different from a pivot in just a moment. In February of 2009, in December of 2018, and March of 2020. So these are not examples of when rates were just cut. These are examples where the Fed stepped in and said, we are going to support markets. We will stop at nothing to support orderly markets. And you'll notice every single one of these dates aligned with the bottom of the market. This is very different from a Fed pivot, because see, a Fed pivot happened substantially earlier. Now, what's actually interesting is we really only had 2 recessions where the Federal Reserve promised intervention. Prior to all of these examples, prior to the top 2 examples here, in all of these segments here, the Fed hadn't yet created the precedent of bailing out the stock market. So really, this chart is only giving you 2 examples, or should only be giving you 2 examples of the Fed's actions. And yeah, the Fed cut rates in August of 2007, and the market didn't bottom until when? Until the Fed conducted their unlimited bailout in February of 2009. Look what I wrote right there, February of 2009. Just to clear up the S&P 500 bottom, the S&P 500 really bottomed in September through February and March of 2003, and that's because you kind of sat along this bottom of like an $80 to $90 S&P 500 range over here. So that just explains why we have a little bit of a disparity in terms of the S&P 500 bottom here, where this chart says the bottom is September 2002, but pricing was really the same until the Fed bailed out markets in March of 2003. And so what I want to make so crystal clear here is that people today are saying, oh, the Fed pivot of reducing rates is actually going to be bad news. And the reason it's going to be bad news is because look at this chart. Every time the Fed has cut rates in the past, it's been bad. and the S&P 500 didn't bottom until some other event in the future. Okay, that's fair. So what we have to actually look at, though, is since the Fed has established a precedent of bailing out markets, when do markets bottom? Markets bottom when the Federal Reserve bails out markets. That's when markets bottom, generally. However, what's different between our recession today and the dot-com bubble and the great financial crisis? Well, let's talk about that. The dot-com bubble was basically a 3-year-long process, a 2.5 to 3 year stock market crash. By many accounts, our stock market today has crashed 3 times as fast as the dot-com bubble. And that's because they're caused by different reasons. The dot-com bubble was caused by speculation in dot-coms, internet companies that failed to produce a profit. So speculation led to a rapid appreciation of prices and then a collapse when the realization came true that, wait a minute, fundamentals actually matter. So the dot-com bubble was a speculative mania that crashed when people realized fundamentals mattered. It had nothing to do with the Federal Reserve, but the pain finally ended when the Fed backstopped markets in the spring of 2003. The great financial crisis was a mania mostly related to credit default swaps and derivatives based on the real estate market. Speculation in real estate, spectacular crash in real estate, Fed backstops markets in February of 2009, aligning with the bottom. These market bubbles and crashes actually have nothing to do with the Federal Reserve rates. They have nothing to do with rates. How is that different from our recession today? Our recession today is entirely based on the Federal Reserve raising rates to crimp inflation. That's very, very different. So again, if we look at this chart, we're like, wait a minute. The Federal Reserve has only had a precedent of bailing out markets in scenario 1 and 2. When we look at scenario 1 and 2, both of these were caused by rampant speculation in stocks and real estate, and then they were bailed out by the Fed when they crashed. The recession we have today, sure, it might have followed speculation after stimulus, but the recession we have today would not happen if we did not have high inflation. See, the Fed is driving today's crash. Again, let's summarize that, right? .com was speculation on stocks. Global financial crisis, great financial crisis, speculation on real estate. Today's crash, fighting inflation. And we do that by raising rates. This has nothing to do with rates. This has nothing to do with rates. These are entirely different market-driven crashes. And so, because today's crash is driven by rising interest rates, we actually believe that the Fed pivoting today will equal boom time. And the reason for that is the Fed will only pivot when inflation meaningfully rotates down, right? So when inflation meaningfully rotates down and the Fed pivots on rates, the reason for our entire crash goes away, which is completely different from these two crashes prior. And it's also completely different from the precedents that we've had in these prior recessions, because you have not had the Federal Reserve bailing out markets until 1987. Now, you could go back to the Volcker era recession. That would be a fair comparison. You could go back to the double dip recession of 1981 and 1982 over here, and you could say, hey, well, we got Paul Volckered here. And why all of a sudden, when there was a pivot, did we take 13 months to hit bottom? Well, that can also be explained. And this isn't to say that what I'm telling you is 100% going to happen. Nobody has a crystal ball. But my point is to say, and I hate saying this word, because this phrase, because I know it's the most dangerous words in investing, or this time is different. But quite frankly, this chart is totally different from today. It doesn't mean we're not going to crash more. But this chart is a bad example, okay? So what was different in the 1981 recession and 82, and why did that pivot lead to 13 months more of pain if they were also fighting inflation then? Because they weren't just fighting inflation. They were fighting inflation expectations that were highly unanchored. Nobody believed in the US dollar. We left the gold standard, price caps got lifted, inflation became embedded into society. Nobody believed that the Fed could actually control inflation. And that led to what? Mass unemployment. We're talking about 10.8% unemployment by November of 1982. That is substantially different from the 3.5% unemployment we have today. And even though we expect unemployment to rise, do we think it's going to go from 3.5% to 5%? Or all the way up to 10%? So, what's my bottom line takeaway out of all of this explanation? No, the Fed pivoting is not bad news. Like, anybody perpetuating that, I just want to grab them by the shoulders and going, this entire crash is caused by the Fed raising rates. What do you mean? The Fed no longer raising rates is not going to stop the crash. That's illogical. Maybe I will be wrong, but I'm not the kind of person who's not going to give you my opinion. I will give you my opinion. And sometimes I'm wrong. That's what happens when I give you my opinion. If I never want to be wrong, I'll just tell you the same thing in every single video. I'll read the news. I'll tell you what the news is. I'll tell you to buy index funds, and I won't give you my opinion. My opinion is that when the Fed pivots, the market will boom even more. However, that doesn't mean it's going to align with the bottom. That's because the bottom of the market is now so clearly aligned with when the Fed U-turns that markets will try to price in a Fed U-turn before. So I actually expect the bottom to precede the Fed's U-turn, because remember, the Fed does what the market tells it to do. I know that sounds crazy, but it's true. Because it's like, why does the market want things to go down? Well, because the market's like, oh God, inflation's going up. That means the Fed's going to have to raise rates. And then we start pricing in that the Fed's going to have to raise rates, and then they raise rates, right? So anyway, hopefully this is insightful. If it was, consider subscribing. Listen, I want to give you, my goal is to give you a fair balance of bad news and good news, because that's just news. Sometimes there's good news, sometimes there's bad news. Sometimes there's more bad news than there's good news, and then vice versa, right? Anyway, hopefully you found this helpful. Check out Mojo. Thanks so much. Bye.